Welcome everybody to our webinar on containing runs on solvent banks and the AT1 market. My name's Tim Phillips. I'm going to be moderating for the next hour and a quarter. Welcome to everyone that's streaming this on YouTube as well. Now, in the last 15 years, we've seen a strengthening of regulation to make bank recovery and resolution less messy, less scary as well. But the events leading up to the Credit Suisse takeover showed that these well-meaning reforms, well, they may not always be fit for purpose. So what's worked? What doesn't work when banks are undercapitalized? We're going to spend the next 75 minutes today discussing what reforms could be made and why supervisors are going to need them. Our panel today, just two people will be speaking. We have Beatrice Weder di Mauro. Of course, she's the president of CEPR, also the Geneva Graduate Institute and INSEAD. And she is one of the authors of the paper, The Need for Reform After the Demise of Credit Suisse, which she was involved with in her role as one of the members of the Swiss government's expert group on banking stability. After Beatrice speaks, then we will turn to Enrico Perotti, who is Professor of International Finance at the University of Amsterdam, also a CEPR fellow. And most recently, he produced a policy insight for CEPR. He's one of the authors of Containing Runs on Solvent Banks, Prioritizing Recovery over Resolution. Now, that means there's going to be plenty of time for your questions as well. There is a Q&A tab. Please use it to ask your questions. They come to me and I will be able to put them to the panelists. If you don't get your question asked, but you didn't ask it on the Q&A tab, well, it's not my fault. But I know we're going to have a great debate today, and it's great to see so many of you have come along for this. First of all, Beatrice, I'd like to introduce you to present on what happened at Credit Suisse.
Thank you very much, Tim. It's a pleasure to do so. And I know that we have a lot of people who are interested, I suspect mostly in the second part of the title, which refers to the AT1s and which probably caused, internationally speaking, the biggest echo of the on impact of the way that Credit Suisse was handled in its final weekend, this partial bail-in of AT1s. And that's also going to be what my presentation will mostly focus on. So I'm not going to speak about the broader lessons from the Credit Suisse experience, and I am mostly going to be focusing on this particular part of this, let me call it partial bail-in, and what can we learn from it for the broader regulatory framework. So I do need to take a step back, though, and start by sort of setting the ideas. What is the structure of Swiss capital requirements for GSIPs? They are subject to something that was within the too big to fail framework that has been put in place over the last 10 years. Which is also sometimes called the Swiss finish, meaning they are somewhat higher than the ones required at the international level. But otherwise, they are very much in line with the structure of capital that has been put in place. Namely, there is the core CET1, of course, and there is an additional layer of additional tier 1 equity, which in the as a share of the RWAs cannot be more than 4.3%. And then on top of that layer, finally, we have the bail-in bonds, which amount to 14.3%. So this is the total the total TLAC, going concern and gone concern, consisting of these three layers, and there is a read across for the leverage ratio also for GSIPs in Switzerland. Another background that is important is what does the too big to fail framework for resolution look like in Switzerland? And this is a slide which is taken almost straight from the website of the Swiss supervisor called FINMA. And, I've added a few handwritten remarks to clarify that we have a very important point before that anything that happens is called ingoing concern. Then there is this point of non-viability or PONV, and after a point of and this is something declared by FINMA, after the PONV, FINMA in cooperation with foreign regulators would take over, and in gone concern then decide on resolution options. So the point that we are focusing on today here is actually on this part. So it is going concern. However, it is not quite business as usual anymore. It is when the bank is approaching or has some troubles and maybe approaching the point of non-viability. And in recovery, one of the actions is to trigger the high trigger caucus. Those are the AT1s. So that would have happened if the bank themselves would have triggered them, and I will come in a moment to what the triggers are. But it is very important to distinguish between this part of the capital structure, which is going concern, recapitalization, and recovery, and the gone concern, where it is about the bail-in of the rest of TLAC, and which is then no longer, which is then orchestrated by FINMA. And in fact, this recapitalization by bailing in the rest of TLAC would have been the alternative as prepared by FINMA on the resolution weekend if the merger or the acquisition by UBS had not worked out, then the FINMA would have triggered the point of non-viability and bailed in. I'll talk about the numbers in a moment. What is finally, if that hadn't worked, but remember that, if you do this full bail-in, and again, I'll talk about the numbers in a moment, this new Credit Suisse on Monday morning would have woken up with a very, very high capitalization. So there would have been a good chance of moving back into viability terrain because it would have actually had quite a lot of buffer to reposition itself and rebuild the business model and its trust. What would have needed, and this just as a side, in any case, and that is the main reason why emergency law was needed in the case of Switzerland, what would have been needed in any case was funding and resolution, and the public liquidity backstop that was being put in place with emergency law would be necessary in any type of this resolution scenario. By the way, that is one of the lessons that we're not focusing on today, but it is one of the broad lessons from the Credit Suisse experience. Finally, what I put here in this red box is what many people think the alternative would have been, especially in Switzerland. This is a very frequently a misunderstanding that the alternative would have been a full restructuring, breakup of the firm, only focusing on maintaining the Swiss systemically important functions and letting go everything else, more or less into some wind down. But of course, this would have been very, very disruptive, and because the systemic functions worldwide would, in that scenario, not have been maintained. And so that was not the alternative. The alternative really was a full bail-in, and what was happened is the partial bail-in. Now, I spoke about the numbers. Here is what Credit Suisse capital looked like at demise in Q1 2023. So last year, it had about 35 billion Swiss francs of CET1, about 17 of AT1s additional. So this is the going concern, and then another the total TLAC. So another about 50 for about 100 TLAC billion, which amounted to about 40% of RWAs. Now, if you don't, and way above the minimum requirement that I showed you before. If you don't like risk rating, here is the corresponding in leverage ratios. So again, about 100 billion, and that for a 15% leverage ratio over the leverage ratio denominator, which is somewhat higher than total assets. So the numbers are these: 17 billion were bailed in, and about 50 billion of bail-in bond holders were happy on Monday morning that they were not bailed in. Now, just briefly on AT1. So in theory, AT1 instruments, why are they considered tier one equity under from a regulatory perspective? Well, because in theory, they are perpetual, interest and repayment are discretionary, and they should be absorbing losses in going concern, as I just showed before. So before the point of non-viability has been breached. In practice, however, they have proven not to have all of those properties usually. Usually they are called at the earliest call date. Interest is paid even in difficult times, very often, especially in difficult times, to avoid negative signaling to the market. So they turn out to be rather procyclical. This was, in fact, the experience of Credit Suisse, who as late as in 2022, issued AT1s at almost 10% coupon, rather than not calling them. So for those of you who have been, involved in this regulatory discussion for more than 10 years, then you will definitely remember all the discussions that there have been around about the optimal triggers of these kind of convertible bonds and whether they should be automatic, market-based, or discretionary, regulatory-based. The point is that the Swiss AT1s were typically issued with two trigger points. Either the capital ratio falls below 7%, so that's not the 5%, 7%. That's why they are called also these high trigger cocos. So either if capital ratios had fallen below 7, which they never did, I showed you they were about 14, or if there is some kind of event called a viability event in which the government feels compelled to intervene to stabilize the bank. And this is the second, under the second trigger, is that FINMA wrote down AT1s. So partial bail-in lessons, this is not a full set of lessons, but lessons. So this partial bail-in and recapitalization of CS did the job in the sense that it made the bride fit for marriage, avoided the bailout by taxpayers, and also avoided possible moral hazards by investors who thought that although these were convertibles, they would never ever convert anyway, because a too big to fail institution would always be bailed out. What is also a lesson, this in particular for investors, is not that all AT1s are the same. So it is really, there is a need to read the prospectus. The ones in Europe are not structured and were not designed in the same way as the Swiss ones. So they were not, they tend to, or they will not be written down without also writing down equity first. And finally, and this in a way is the most important one going forward, is the question how AT1 should be seen in the future as going concern capital, or more broadly, what also Enrico will focus on, how do we structure recovery options before the point of non-viability is reached, and what are the options there? Simply by giving supervisors more power to limit, for instance, interest payments or calling would simply shift the signaling problem to the supervisor from bank management, and may have the same problem of too little, too late. So this is my, thank you very much for your attention. This is the, the warm-up for now, Enrico Perotti.
Thank you very much, Beatrice. Just one quick question on that. You showed the structure, the resolution structure. At a year's distance now, a year after, do we say that what happened at Credit Suisse is the system working like it should have worked? Or was it we did a lot of things, whatever it took to do it, and it worked out okay in the end?
Partially, the system worked as it should have worked, because that's what I was showing. In principle, these AT1s were designed to do this job. But there were a lot of other things that were not in place. In fact, I already mentioned the public liquidity backstop had to be put in place with emergency law. This type of resolution had not really been foreseen in the too big to fail framework. And moreover, as I also mentioned, I think there was just a lot of misunderstanding about what this framework really entailed, and there are also some. I have not mentioned those. There are also some issues with the question: if one had done the full bail-in, what kind of uncertainties it might have created in other jurisdictions. So the system definitely still needs a lot of work, but this partial bail-in part was in fact designed to do what it did.
Thank you very much. I suppose this is what happens when you turn on a sophisticated machine for the first time, isn't it? Enrico, over to you now to talk about your work on how we contain runs on solvent banks. You're still muted, Enrico.
Yes, thank you. I was looking for just that. Well, first of all, thanks for having me here, and particularly thanks to Beatrice for a fantastic introduction. She laid out the whole vocabulary of what we're talking about, because it is a complex construction. And also, it's not just what you see, the mechanism when you describe it, it's also, as the question by Tim pointed out, is that once you get a mechanism running, you really test whether it works. And there's so much that we can learn. So let me move on to what hopefully we learn, or what we can learn from what happened. So I'm going to present work with Eduardo Martino, who's at the Amsterdam Law School. I might also say that this work ultimately comes from published and almost published work with that I've done for years. So I want to mention Natalia Martinova, Rafael Mata, and Javier Suarez as people that I worked on the construction that ultimately comes in. And what I was working was essentially, I was working on preventive measures. And that was not something that we had done a lot, with the exception of COCO. In the books, but in the EU, we've done much less than in Switzerland. So there was actually very little there. And I think that when the time came, I think the work I have here is reflecting exactly this insight built over the years. But let me see how I change this slide. Okay, let's see. Yes. So quickly, I'll tell you things you already know. We went through a really fast Raleigh sort of circus ride, with first a very flat interest rate in the extreme case under COVID, very rapid increase in inflation, and then we had the distress that comes from all this sudden withdrawal or liquidity, or in any case, increasing cost of liquidity. We had very large defaults in the US. I think it's quite inappropriate to call them medium-sized banks. These are huge banks by European standards, certainly. The one exception of bank that managed to escape this distress and these runs was Credit Suisse, for the reason that Beatrice explained. It was set up, in a sense, to not be bailed out. Every other case led to a bailout, as in fact, pretty much almost any resolution we've had since the financial crisis. But what is specific to learn here, besides the fact that obviously higher interest rate would increase liquidity risk, is the fact that too little was done for too long. And this is part of what, talking enough to regulators, you start to realize that there is something that you need to see behind the scene, which is that people do see what the problems are, or at least they shadow the problem, but it's very hard to act. And the inertia that comes forward in the end, is forbearance, is what ultimately leads to further deterioration. It's a very bad idea to allow a bank that is compromised to keep operating in that context. And then ultimately you don't escape the runs in the. So in the point of the policy insight that was cited, which is a longer document than the column, which is just a few pages, is essentially we have a blind spot supervision. We are a bit at the mercy of runs. And the problem is that once the banks start to get a bit in a sort of unclear situation, there are hardly any recovery tools. In Europe, we have a Recovery Resolution Act. I remember when I read it, I thought this is our resolution. We almost have nothing. And of course, it's difficult, as we will see. But the punchline is that whatever tools we have, we also don't use. And the remarkable case is Credit Suisse. There are many reasons for the delay, but ultimately there was a real extreme terror of moving, in part because people feared it could be runs. The bank was already being spoken for quite some time, and ultimately you end up in this sort of recapitalization game in which the banks just doesn't come up with enough risk absorbing capacity, and the regulators can do little at that point. And they do little because they're afraid of runs. And runs, let me say this, are treated as a black box. Once the run starts, you're finished. There's nothing you can do. And having worked for a while on bank run incentives, I think you can open the box a bit. That's sort of what we'll try to do. So once again, the scale of the problem is large, not because there are not too many banks like Silicon Valley Bank, fortunately, or Credit Suisse, but there are many banks which have large losses in the banking book. And the numbers are alarming, particularly in the US. In Europe, it seems that that is better accounted, although there are definitely losses. But if you have losses on holding of safe asset, should you be closed down immediately if you are a viable bank, you have a business model that can operate? Should you be just surrender to runs? And what we put forward is the notion that essentially we need something that does exist in the private sector for non-banks. The idea of a recovery regime, a form of special administration where you have a financial restructuring, something Chapter 11, which is impossible in banking because banking is based on creditors with demandable debt. And they, if people run, they're not going to entertain your suggestion that they go home and take 95 cents. They'll take their dollar now. But so that we need specific action tools that have a clear mandate. And here I'm echoing the concern that Beatrice described in the activation of the Credit Suisse tools. And they have to target both capital and liquidity. Ultimately, a bank that is in distress has a solvency risk. But as Beatrice again emphasized quite correctly, once you're trying to handle a situation of a bank that is undercapitalized, you need to do something about liquidity as well. So ultimately, like one of the punchline will be that to make credible any form of intervention, which is corrective, prompt corrective action, which does not involve default, so a going concern intervention, you need a tool to contain outflows. So that's going to be the second one. Let me just give you a little visual impression of what is different here. So think of runs as flooding risk. I mean, I live in the Netherlands and my house is 2.5 meters below sea level. So, how do you contain flooding risk? Well, of course, the first step is dikes, of course. Dam and dikes, high buffers, and these are essential, and they are not likely to be raised a lot in the coming years. That's what I sense. There's little appetite. There are enough problems out there, and this is a battle that it's not clear the politicians will endorse. Of course, we could also accept flooding, and they say, well, you know, things come, act of God, and we compensate by bailout to deposit insurance. And you know, there is this for, I think, most economists is just anathema. This is really allowing risky banks a free run and create huge risk incentive and a large fiscal cost. There is a third solution, which is to have contingent measure. You store sandbags, and that means measure on both capital and liquidity. On capital, we will talk about how the conversion AT1 debt can be improved, learning from the lesson of Credit Suisse, the only conversion going concern ever happened on the planet. And the second component, which is quite innovative, but in the end is a transplant from legislation money market fund, the possibility of introducing temporary redemption charges on uninsured deposits when outflows start to pick up. So this is pretty much the menu. So let me talk a second about what I call the intervention gap. You know, you have banks that are solvent but undercapitalized. I'm going to spend some time trying to define this later because, of course, it is critical. And currently, you know, you have two choices as a supervisor. You do forbearance, and then, you know, in the end, if you don't intervene, the losses accumulate. And the incentive on under debt overhang are terrible. We know that, and so in the end, you have ultimately some run. If you could also try to intervene, you have public your capital guidance process, but the tools are minimal. I mean, you can stop dividends. I mean, this is a bank that has trouble. I mean, if you stop the dividend, this is not going to save anything very much. So if you go public and you start pushing visibly and trying to demand more adjustment, the runs are an immediate risk. So, you know, how do we get out of this trap? Because, of course, the result in this little model is clear, and you have forbearance, at least you buy time, and to some extent you gamble. You hope that the problem goes away. All right, so one of the things I want to do is to spend a second on the run risk. So let's understand this build-up of runs. So you have historically outflows that take time before the bank is run. You have, and then they sort of accelerate. And typically you end up having some adverse news, and then you have some people withdraw upon the adverse news, and it's, you know, intuitively that those that do need liquidity and they cannot afford to have a trap or loss will immediately withdraw, even if the chance of, you know, the solvency is not that clear. Some people will front run. You say, oh, we better be ahead of others. And there will be totally risk intolerant people. They don't need the money, but, you know, they'll take no risk. But, you know, most depositors are not in these categories in the end. And so here we have to think about the moment in which you've had these withdrawals, like, you know, Credit Suisse had them already in 2021, 22, and you approach, and, you know, when the withdrawals start to build up, though, as they did after waiting too long, the key question for everybody is, should I run too? I mean, I don't need the money. It's not clear this is a problem. And the key question is, what do I think others do? And in the time in which there is such possibility to coordination via social media, it is really scary that how quickly people can coordinate on the feeling of, oh, others are running. And so it's actually a pretty easy thing. I mean, it doesn't cost you anything to withdraw, and therefore you end up in this category of self-fulfilling runs. You have banks that truly should be closed down, and they should be closed down before the run, but they also run for banks that are viable. They would, and you know, if they're challenged by depositors, they will, of course, go under because no bank can generate all that liquidity. So here's the question. can we find a moment in time in which there's been this outflow? So here what I have on the axis is the scale of withdrawal, cumulative, and then the time. Now, the idea here is that you have a buildup in a withdrawal, and at some point they might escalate. And they escalate precisely because of the self-fulfilling component. People say, okay, I don't need the money, but if others are running, I better run. So the path becomes convex. If you were to target the introduction of some cost of exit, redemption charges, then you might be able to target both the direct effect. Oh, wait, I'm going to leave some money on the table if I demand today, as opposed to wait. And even more importantly, you will affect the indirectly the incentive to run, because you'll say, oh, maybe other people want withdraw. If you have to leave 3% on the table to withdraw now, maybe they won't run. So if you can break the expectation, you break the escalation. And that means that if you open a box of a run, there is a point where you can intervene and stymie the buildup. This is precisely what is now the norms for money market funds in the US. The SEC spent 10 years figuring out how to contain runs on money market fund. And I think this is seen as an automatic market stabilizing mechanism. It doesn't require necessarily much of a supervisory action. It is to be seen as an automatic stabilizer. Think about congestion charges. Too many people drive into London and you start paying a fee. Well, that's just, I think, part of, it's quite reasonable. But the really important element is not just the charges, but, suppose the charges help you in thinking that people will not run so quickly, so you can move. And the idea is that you have to give enough clear power to the supervisor, because the supervisor will have to run a recovery regime, not the resolution authority, to act. Just as in a financial restructuring packaging, typically overseen by some expert. So it would be a short-term mandate. It would be because you don't want the supervisor to accumulate responsibility for the bank going forward. It is about a quick cleaning up, but then with significant power, as in the resolution regime. Not as strong, because you're not going to override all sort of things, but you have to have distinctive power. And that makes it clear the supervisor can act. There shouldn't be any doubt that this is their purpose. And the idea is to have an orderly financial restructuring and also adjustment probably to the risk management or perhaps basic governance function. So the idea is, again, the bank, saving the bank would be a positive NPV, considering the additional cost or I think the disruption, and of course the bailout. You need to have a legitimate trigger. It's very important. And the intervention has to be justified and proportionate. These are criteria that you have to meet, otherwise you'll be sued all the way under common law and probably even under civil law. It would be untenable. Ultimately, what you also need is as a criteria for legitimacy is a consensus among the people that are behind the scene and have all some role to play. Supervisors, obviously, the central bank, I'll explain why, the auditors that certify, in a sense, the current state of the balance sheet, and also market indicator. And here I want to break a lance for Viral Acharya's work in this area. You can never rely on a market, an automatic market trigger, but it's certainly foolish to ignore market information. It would have been useful in all of those defaults. And the very simple idea is that you're going to have some indicators and you need 3 out of 4 as a threshold for action. I'll describe the indicator in a moment. What happens once you start the recovery process? Immediate conversion AT1 debt. For that reason, of course, it has to be that you have a significant amount of it. So I think that is another issue. Unfortunately, the idea of construction is complex, that require different parts, but in principle, that would be very helpful. Redemption charges would be activated upon large daily outflows, say 5% of uninsured deposit. And these redemption fees should be considered an ongoing feature, not something that only happens under recovery, but it clearly helps stabilize outflow at the moment you intervene inside the bank. Another point, and here I address again very explicitly the issue of liquidity under resolution. You need to convince the bank, the central bank, to offer limited ELA support, such as what in the end they end up doing in resolution, but then here a capped amount justified by some collateral, sort of generously discounted. And obviously this is a potential bailout component, so this is what justifies also supervisory powers. Yeah, so automatic charge already I've discussed. Yeah, I'm moving fast, but let's talk about a moment again about the run. I think what is very important is that the supervisors not only have the power to act, but they dare to act. And for that, it is important that they are in a safe place, not only legally, but also financially. So what you need is that if there is an intervention, you need to stop the expectation that everybody will run. You have to stop that escalation. And again, the idea here is to have a market. It's a matter of market integrity. That's why the FCC is a regulator, not Basel III, for money market funds. I think those uninsured deposits are typically held by corporates that traditionally hold their money in money market funds. So, you know, there is a functional equivalence between money market fund cash pools by corporates and corporate deposits. Interestingly, when Silicon Valley Bank was run by the corporate depositors, guess where the money went? Into money market funds, which, you know, are not perfectly safe and are subject to redemption fees. Okay, so now, as I already say that, it's very important to see that there is a direct effect of charges. It costs me money to withdraw now. Why would I do it? Do I really want to do it? And the key question is, what are others doing? And to the extent that the charge discourages everybody from running, well, then I can be reassured that that escalation is not an obvious thing. In any case, you know, I retain access to my funds. There is no gates. I just pay for the fact that I demand liquidity at the time where it's scarce. And in that sense, I think there is going to be some degree of front running, probably in this with these fees, but it's not probably as bad in terms of stopping institutions and corporates to have access to their funds as gates, which I think have lost. Now, okay, if you put together the component, you see that you have the possibility of introducing a regime that is attractive to supervisors, credible. It's credible largely because it cannot be, it would not be easily challenged by runs. And actually, in case if runs really occur, well, then there would be some partial bail-in for once of someone. I mean, funny enough, you know, if you pay charges of 3%, given the leverage ratio of many large banks, the bank will kind of recapitalize itself as the run goes. Paradox, or not suffer too much. Okay, now the issue of legitimacy is very important. Which bank do you decide to intervene and which not? I mean, the principle should be as simple as possible. Financial principle, which is, by the way, the principle of a financial restructuring workout. The firm is in debt overhang. We need to put it back on the road. If he has positive NPV continuation, then we should do it. And then we, you know, everybody's better off if, in the case of a corporate, to do the right restructure. So you have to look at the business model of the bank. You have to see if you have a proper franchise. That's the criteria. And what is the trigger that will ultimately make you activate the recovery regime, market value of equity, perhaps bonds, and large outflows are the market signals. You need, of course, a balance sheet valuation by auditors, supervisors, looking at hidden losses. And finally, you need a viability assessment and risk control. Sorry, viability and risk assessment by supervisor and the central bank, specifically liquidity stress test to some degree. Because in the end, the bank will have to float on its own. So somehow, if you compose a series of indices, you're not going to be at the mercy of market sentiment. You're going to have discretionary triggers, but you also have the pressure of acting as opposed to, sort of forbear some longer. And of course, the first step is to decide whether you go straight into the resolution. And but if that is decided that it's not the case, then you need this regime to be in place. Now we've done some basic calibration. I want to leave a bit of time for discussion here, and I think we also want to. This is drawn, by the way, by my VoxEU paper column last year about on this related question. I found a useful way to compile the effect of different reforms. So what I have is here on different kind of reform, the ex-ante measure that people put forward, deposit insurance and higher buffers. And these do allocate risk either to investors or taxpayers. So these are the two polar examples, if you want. They have effect on insolvency risk. In the case of higher buffer, it's very clear. And higher buffer also a positive effect on liquidity risk. And ultimately on endogenous risk incentive, like moral hazard. Very positive. Hard to get, but deposit insurance, as we all know, the effect on deposit insolvency risk is quite ambiguous because, of course, you can just promote a lot of risk. It has the worst possible outcome in terms of risk incentive. Of course, it reduces liquidity risk because everybody's insured, but everybody's insured, but a loss accumulate is not a desirable step. By the way, the sort of small legal change that is being discussed at the European Commission would sort of extend deposit insurance. On the other hand, it doesn't really have my agreement. The goal there, however, is a necessary one. The fact that it's very difficult to implement a resolution now because there is no liquidity support in resolution, the current framework. And so the EC proposal is trying to create some bail-inable money to be thrown at people that are running or managing the transition. I think that it might contribute to make a resolution a little easier. I overall think that focusing on resolution it means you wait too long and then you pay a high price. In the case of these two restructuring proposal, they are essentially you're targeting investors and uninsured depositors, which to me seem to be the right one to bear risk in terms of risk capacity. And I think they target specifically insolvency risk and liquidity risk. So, they are not as positive as higher capital norms, and they're, I think they're better the resolution whenever that is possible to be achieved. All right, I conclude. We do have to learn about what is the specific lesson of the 2023 banking crisis. There's things that have, we could have a higher capital, and then, if we have a higher capital and forbearance, then we're not over the problem. So I think we need to think of contingent measures and clear mandate. And once the mandate is clear and credible, then it's going to serve against forbearance, and that takes us from this very wrong place where we are. We're currently too much at the mercy of run. So I stop here. Thank you to everybody for the attention.
Thank you very much, Enrico. There is so much to talk about there. For anyone who was looking at the models and the tables, they are in the Policy Insight, so you can download that afterwards and have a look at them at your leisure. So you don't have to worry that we had to skip through them today just because there was so much stuff there. But Enrico, thank you for doing such a great job in packaging it up into a manageable form. Just a quick question that's been sitting here from Michel for a little while. Before we go on to the future, just have a little look at the past to say the tools, the existing tools were not employed. He was saying they weren't employed at Deutsche Bank 2015 and at Credit Suisse. Was that because there was a fear that they would contribute to contagion in subordinated debt? Is that a factor, the reason?
It's clear that in the case of the Deutsche Bank, that was fear number 1 and 2 and 3. I think it was, to be frank, the bail-in that postponing a coupon would have, suspending a coupon would be minimal. I mean, it was so minimal anyway. So I think that the truth is that they, Deutsche Bank had already, we already had waited too long there. So I think to some extent, Deutsche Bank is in a different position right now. So I mean, this recovery has taken its path. But we need to have adequate measure because it is true. It is a problem of credibility. It is a problem of spillover. I mean, the whole decision of bailout institutions that were not systemic at all, they weren't even subject to Basel III, is because people fear spillover.
Beatrice, I'd like, before we go to the questions that we have in and keep asking your questions, Beatrice, I'd just like to get your initial impression of what Enrico is suggesting here, how practical and how useful you think it is.
Well, I was delighted to receive this piece of research. I mean, I know that Enrico for a long time has been one of those people emphasizing we need much better incentives and tools for recovery and not only resolution. I think you said explicitly that a lot of we have a much stronger framework for resolution. And the recovery part is more, well, up to, hopefully we do it, and there is much less structure around it. Moreover, as I try to also emphasize in my little presentation, when it comes to the AT1s, in principle they are, and I think Ivan Lengwiller was characterizing that nicely. He was the chair of this Swiss government expert group that we had. He said, well, we have a big tank, which is equity. And if we're starting to run down that fuel tank, then there is a reserve tank called AT1s. But the problem here is, of course, that the triggering of those AT1s is something that management will resist, is something that regulators will not necessarily press on because of the fear that the market signal may just be negative and then trigger negative reactions and downward spirals. So therefore, you may have the reserve tank, but you cannot use it unless you are actually really out of fuel. So that's not an ideal situation. And the changes in the incentive structure for giving essentially more powers, but also it's not only more powers, it's also the way for the supervisor. I mean, at some stage, if there is an automatic reaction, the supervisor needs to enter into a resolution regime here. So it's not only more discretionary powers, but also more obligations of the supervisor to do early intervention. I think that's exactly the right direction in which we should be thinking.
Can I ask you a couple of questions that have come in specifically about Credit Suisse? Miranda was asking, were bondholders right to complain about the fact that shareholders got something back and the bondholders didn't get anything back? And the second one is Credit Suisse wasn't perceived as insolvent by the market, rather that its business model wasn't sustainable. So wasn't resolution a better option? So just a couple of opinions on that.
You asking me?
I will.
Go ahead.
Both of
You
you,
go.
Enrico. Yes, you go.
Gotta be quick, and then we hear Beatrice. I mean, first of all, the fact that market equity is positive on a bank that is undercapitalized reflect just the put. You know, it's not necessarily you're gonna have a bank have positive equity value, but just reflect the fact that it can gamble with other people's money a bit longer. So that in itself is not a. It is true that it's absurd that you have creditors being wiped out and shareholders getting something, but that was a choice of the creditor, because it was their choice to, instead of having conversion into equity, which was the principle behind COCO all along, they chose for something that was easier to set up, cheap, in fact, not very sensible, where you have principal write out, and instead of write down 50%, they chose 100%. It was even easier. So, I mean, that's a private contracting choice. It is a bad option. I think we should remove it. We should really say you have to convert into equity, or at least you have to maybe a partial write down. But in principle, that was a private choice. So again, I think it was all clear on in the contracts what was going to happen. And I think the Swiss were very deliberate in making clear how they wanted the bail-in to happen.
Beatrice?
Well, I am not sure I agree with you that it is a bad choice. If you have this reserve tank, why do you have to run down the primary tank to zero first before you activate your security? I mean, that's what I mean by that is there are options in which you may want to preserve a little bit of equity value for equity holders. And yet, if it is very clear, there I agree with you, Enrico, if it is very clear, exempted, that this is a contract that you are writing and that investors are buying, then conversion could be 100%, it could be 90%, or it could be a conversion into equity, any of those. The problem was that obviously a lot of investors didn't know. And also, I think the problem is that didn't know what they were holding. And they didn't read the prospectus. And the other problem is that the AT1s in Europe are not structured like that. So that also, the European supervisors and ECB came out very quickly and said this would not happen in Europe because we have a different capital structure. And AT1s, in fact, typically trigger at much lower levels. So they are more gone concern than going concern resolution tools, where then one could ask, why are they so different from bail-in bonds if they are only triggered once you are, you've run out of the reserve tank and the main tank, and essentially are by the way, are on the roadside and need the truck to come and get you. So that was the question about equity, and the first one I also wanted to say something. Solvency. It's Credit Suisse. We now understand more and more that it had problems with capital at the right places. So the parent bank did not have enough capital, but there was enough capital in the whole structure. So the diagnosis was not primarily one of undercapitalized bank. It was one primarily of a business model that was completely no longer credible, and both investors and clients eventually lost trust in this in this franchise. So that is not. I mean, I don't think one can say Credit Suisse was structurally undercapitalized. Some parts of it were, yes.
Okay, I want to talk a little bit about the role of discretion in a second, but first of all, there is a question here, and as we all know, there are a lot of people that were very upset because of the way that Credit Suisse was sold, and because a lot of people did lose money from it. So someone's questioning about, well, the phrase is the integrity of the financial regulators, but I guess we could say that a lack of transparency and the fact that there was a restructuring plan that was approved that was never adopted, and also that when bonds were issued fairly late on by Credit Suisse, then the people who bought the bonds got a very bad deal of that. Is there an argument that one of the problems here is that the regulators just need to be far more transparent about what is going on? Enrico.
Briefly. So in a governance, you need transparency, but banking is a special business. If you are banking, there is, because of this externality of runs, transparency. I mean, if you talk to, read some of the work by the great Charles Goodhart, he's very real about the fact that, you cannot just keep disclosing everything to the market, expect the market to fix it. Well, either understand or not coordinate on the wrong bit. So I think you need to be as transparent as you can, but I think it's also, we've moved to a situation where now regulators are trying to, hide trouble, or maybe not even trouble, but the sort of bad signals that can create a run. It is possible Credit Suisse was not incredibly undercapitalized, etc. But there were rumors, there were enough signals that it was poorly run. And so any of them can be a point of aggregation for a run. And so, so full disclosure of the regulators for me is fine if you give them clear tasks, clear tools, and then they can act in the full light. Otherwise, you keep hiding behind the finger. Oh, this side, everything is okay. So I think integrity, I question the integrity of regulators that just don't do anything, just end up having us pay for it. So I think it's a bit too easy for market participants to be feel swindled when there was a contract they could read. Nothing was done that was not in the contract. So on the other hand, people will keep an opinion on that. The real question is, if you want, perhaps it is true that we need to create a much more transparent, clear assignment of power and responsibility, so that you can see what the regulators do, and then you of course have to stand up to account.
Beatrice.
So I think it really, I mean, it was a first. It was a first. So investors can be really may have not anticipated that these instruments could actually be written down to zero, even though it is super easy to, you can Google it up anytime now and just look at the AT1s that Credit Suisse issued at the prospectus. It really says it there, right? What can happen under which circumstances, that there are these dual triggers, and one of them actually did happen. So the other possibility is, of course, that people were speculating, that they were thinking, oh, this is too big to fail, it will never happen, I will never lose my money, and in the meantime I make 10% on these bonds. That is a moral hazard trade, and in that sense, it's quite good that the demonstration was made that this is actually equity and not bonds, or supposed to be, because that is the idea of these instruments. And if we cannot use the instruments as equity to absorb losses in going concern, then we have to question the value of such instruments. For the system. not for the investor, of course. Now, the supervisor, I do think that the point that Enrico is making and that we really should be talking much more about is how can we give supervisors not only the right incentives and the right powers, but also the mandate, the rights and obligations to intervene early without then being, basically accused of breaking the bank. So because that is of course their dilemma that leads to forbearance, as Enrico was saying. So prompt corrective action measures and regimes, that is a area where much more thought has to be put. And as you also correctly emphasized, Enrico, that some of the triggers should be more market-based rather than the regulatory capital and liquidity ratios that may not be appropriately signaling the actual distress in the business model, for instance.
Beatrice, can I come straight back to you? Because I've got a couple of questions about AT1s, and I know that a lot of people were attracted by the mention of AT1s in our title. And it's basically the same question. Should there be you pointed out the nuances of AT1 contracts. Should there be a standardized AT1 contract? And should there be an effort to make AT1 contracts clearer so that people could understand the regulatory differences?
Sure, I think that should be one of the takeaways. In fact, UBS has now issued AT1s which do not write down but convert to equity, if that is sort of considered more like a market standard and what people would expect. But it is important, I think, for those who are quite upset about losing on their AT1s, is that equity holders also a ton. So it's not converting into equity when equity is not worth very much is not going to save you, would not have saved AT1 holders a huge amount in the case of Credit Suisse. But yes, the answer, standardization certainly is important. But both standardization and disclosure, transparency are kind of the sort of automatic reactions that we always have. I think we also should be focusing more on incentives.
Okay. Enrico, I want to talk about these sort of automatic stabilizers that you discussed a lot, the redemption fee. Because we have a question coming in to say, if the risk of flooding was so severe, we have a lot of metaphors in this webinar. If the risk of flooding was so severe that the water nearly reached your front door, would a redemption fee prevent you from leaving? And could investors think that they're losing more than the redemption fee? So it's a question of whether this 3-5% that you've adopted from the money market funds is correct, is high enough, is appropriate. We'll find out when it's tested, I guess, if it is. And a broader question coming in from Philippe at the top. They're looking at the consumer side. Can we learn and implement anything from behavioral finance to influence bank runs? So yeah, I think in your area, Enrico, here.
Well, briefly, it's clear the sandbags won't stop the flooding. But the issue in the financial system, you create high dams everywhere. And then there is going to be a weak spot somewhere. And so the key is to stop that weak spot from getting larger. That's why the sandbags are useful. Yeah, I mean, the best thing you say, why don't you put already a sandbag on the dike and make them higher? But look, first of all, every time you raise capital, you increase the incentive to gain it. There is always going to be something unexpected. And so once you are in that situation where some area is weak, you need to have tools. You can't just say, oh, well, you're either solvent or bankrupt. If you're bankrupt, we bail you out. But we had a high dam, so it shouldn't have happened. That's not good enough. I think there has to be something you can do contingent. And again, it's going to be, the key is to activate in time. Because if you activate in time, the water stops rising, goes down. I mean, this is, okay, the behavioral, conjecture or maybe hope that if you can reduce the expectation that of course there's going to be a crash in the dam, then you don't have the same pressure of people going in there. I guess people are even trickier than water, because they'll, if there is a breach, they'll go there. So that's my point. If you wait too long, it won't be enough. But okay, let's take the worst case scenario. They don't work. The bank ultimately fails. Okay, well, you got some bail-in. There is in our proposal the idea that all the money you raise for the charges, you could put on the account of, to pay first the depositors who didn't withdraw. I mean, you can change the terms. You don't have to surrender to runs like, oh, well, if they come with that, we can do more than that. But ultimately, yeah, it could be that in some case you try, set it up, and the run keeps going, and the bank would be in resolution. You get 3% bail-in, which is the best that we have done in many cases.
Now, we only have a few minutes left, so I'd like to ask both of you at the end of this. We discussed lessons learned and things that will possibly make regulation and supervision better in the future. What are the practical obstacles to this, and what are the practical chances that we're going to get more reform in a timely way? Beatrice, could you do that one first?
Oh, that's a hard one. I mean, the whole, my focus is on GSIPs, and the whole too big to fail framework has, took a long time to debate, and then an even longer time to implement. So I don't see that right now. There are very, very strong forces for some fundamental rethink, but there are clearly things that need to be fixed. Weak points where the current framework may just fail to deliver what it is promising. Mentioned in passing, liquidity and resolution is not in place in Europe. We have questions around the possibilities to do bail-ins. And we do have to make the AT1s viable, in the sense, standardization was mentioned, but also clarifying what they are for and what they aren't. And I would put on that list, but I don't see that there are many strong discussions in this direction, which is why Enrico's paper is so useful. Much more early intervention and not waiting for resolution, but more options in recovery.
Right, Enrico, what do you think? You have your plans here, sensible or not? What chance have they of becoming the way that regulation's done?
Well, so let me say, by the way, that since I joined part-time advisor to the Dutch Central Bank, and I should have said earlier, what I'm saying does not reflect necessarily the Dutch Central Bank.
Okay.
So let me be realistic. It's very difficult for non-standard or new thing to be pushed in. Although if something is big enough, it's always in crisis that structural change stuff. Look at the European banking union. I think that the crisis is not large enough to activate that. There is a lot of regulatory fatigue. I think that politicians are distracted by plenty of other things. I'm, skeptical that you could do something completely coherent and comprehensive, unless the problem spreads more. What is possible, though, is to shift the thinking on a couple of items that are relatively low-hanging fruit. Once again, I think it would be really silly if we didn't do much more than, say, adjust liquidity risk weight on corporate deposit. That would be a failure to learn what is going on. So I think the charges are up against a little mental block that people say, oh, that's a bank, it's not more like a fund. But I think in very functional equivalent terms. and I don't think it is anything too outrageous. The charges could paradoxically have a bit more of a chance in some form. The learning from Credit Suisse, which I think is the big learning too. I mean, at least as big. Europe has, I mean, US doesn't have COCO, and Europe has a completely useless construction. It's a COCO convert at default. Not a single coupon was ever suspended in 12 years. Not a penny was bailed in out of default. They're bonds like every other bonds. So, sorry. So, I think that the resolution, as we set it up in Europe, is not working very well, and it will continue not to work because the bail-in at the last moment, the political incentives are spectacularly wrong. And giving liquidity assistance under resolution, it's basically a bailout by the central bank. So I think something has to happen on resolution, but whether they will be the determination to do this, I really do not know. So at the very minimum, we need to raise the minimum COCO trigger. They're pathetic. That we need to clap. In Europe, it's true the supervisor said this wouldn't happen in Europe because in Europe, nothing happens, a going concern. I mean, right? I mean, look, if you look after the Deutsche Bank failure to suspend a single coupon, COCO price in Europe stopped pricing any conversion. They're identical to a bail-in about that. I mean, there is research on that. Of course, market, I think Beatrice was very right that people are very outraged because they really didn't expect it. They didn't even price it. They thought it was, oh no, this is just, just a fantasy of supervisor. Of course it's not going to happen. It never happened. And so I think it's also the fault of forbearance if in the end people say, oh, well, it never happens. Why would it happen to us?
Enrico, you're depressing us. How depressive at the end of this nice, hour. You come out with all of this.
It is the end. It is the end, both. Thank you very much for both of you. I want to, before everyone goes, if they want to read more about this, then there is plenty to read. We mentioned, of course, the Policy Insight 127 containing runs on solvent banks, prioritizing recovery over resolution. That is Enrico and Eduardo Martino. There is a Vox EU column, Global Lessons from the Demise of Credit Suisse, Beatrice and Ivan Lengvila. And that's part of the Vox EU debate on lessons from the recent stress test, the recent stress in the financial system, which has been a series of articles from April 2023. Enrico's involved in that one as well. And there is an excellent Vox Talk podcast from Vox EU. I say that because Beatrice is involved in it. What went wrong at Credit Suisse? And that was from the 1st of March. Thank you to both of you for some strong and sensible views. And I hope we do very many more of these sessions because it's clear from what Enrico's saying, the problem's not really solved yet. So thank you, Beatrice.
Thanks, Tim.
And thank you, Enrico. And thank you to all of you who tuned in. And we hope you got what you wanted. And that if you want us to do more of this, let us know and we will. But now our time's up. So from me, Tim Phillips,